Makes sense. If we transition over to the investment landscape, I guess you also look at different segments, investment opportunities. Same there as well, taking the broad lenses. What's been your perspective on where we are today and how the segments look in general? And then we can go a bit specifically one to one afterwards.
I'd say if we take again, from a very high level view, most of the shipping markets have a dynamic where asset prices are relatively high from a historical perspective. And I think you have earnings that are relatively sort of mid to high level, across the board. And what I think that has led to is that a lot of the institutional capital, which is, again, largely what I think folks assume the US perspective to be. There's not a lot of ship owning families that come here that are investing generational wealth into vessels. The perception is it is the funds and the banks that are looking at the space from here in the US. And the view is that I would much rather be the debt provider than the equity provider in the ships. And that is a big change from the 2010s when you saw a big wave of US private equity firms come in and co-invest as equity alongside ship owners or start new shipping companies themselves. The dominant trend now is for US institutional capital to say, I will be your debt provider. I will provide either through a sale leaseback financing, a senior secured loan. I'm not going to be the first loss capital into a shipping transaction, which is some of the lessons learned from that 2010 period where a lot of people got in and got their fingers burned. So I'd say broad strokes, there's a lot of capital out there, but it's specifically looking at the industry from a credit perspective, where folks are saying, well, I don't want to buy that ship at 100% of fair market value and be the equity. But if I could lend at 70% of the value, I'm comfortable there, even if that caps my upside in terms of I will only make the interest rate I charge.
Mm. Is that a testament to where we are sort of in the cycle that has been quite strong years in different segments? So is it like a cycle this, or do you think it can change, giving different market circumstances and so forth?
I think it's a reflection of where we are in the cycle. Again, I think if you take a generalist investment lens, the thesis that attracted private equity funds in the 2010s were investing below the 10-year average, 5-year average, whatever it may be. Now, all of a sudden, when you're trading above that very easy to underwrite return the average thesis is actually a negative outcome, a return to sort of the 10-year averages of fallen asset prices. So I do think it's a reflection of where we are in the cycle. And I think it's also a reflection of added discipline from institutional investors to say, I have seen how this has played out before. I'm going to give myself some extra protection. But it also fits in the sort of that broader scheme of what we're seeing in the boom of private credit generally and narrower banking, where all of a sudden, there is appetite or a need for capital that needs to be filled somewhere. And so, and some folks are finding that private capital sources are plugging that hole compared to, a traditional European relationship-based ship finance bank.
Hmm. How do you screen for attractive shipping investments? Because now we've talked about what the institutional players are doing, but still there's attractive, stock opportunities out there. Do you spend a lot of time on it, or do you focus on the high level perspective?
I think the fun part of shipping is you can wake up every day and find a different rabbit hole to go down. So no 2 days are alike in that sense. I think some of the more interesting opportunities right now you're seeing are around specific situations regarding companies. I think less so than making an absolute bet that the market is going to go higher from here. You're looking at companies specifically. What does their fleet profile look like? What does their valuation look like? And I think a lot of some of the most interesting opportunities these days have been playing around M&A catalysts. You look at some of the recent take private deals, like and if you were a shareholder in those companies and said, listen, this is likely to be taken private at a valuation higher than what it's trading at, I don't need to make a market beta bet that everything is going up. I can say that if someone wants to take this private, it will have to be done at a 20, 30% premium to the trading price. So if I can identify those types of opportunities, that is compelling and sort of doesn't expose you to the broader market dynamic, which feels rather frothy. So obviously you've seen Cool go private. You just saw not tankers, KNOT, be proposed to take private. There have been a handful of those. And then also, Genco's poison pills, and they seem to be battening down the hatches to try to prevent that from happening to them.
But can we take, Coolco as an example? Because I find, that's an interesting part of shipping that, the listed equities can be mispriced or not fully up to valuation in terms of the values of the company. But this is quite a unique history that you can take it private and you have the shareholder you have. So maybe that's just like a good case study of shipping markets in general and why that almost arbitration is a great opportunity for the biggest shareholder, obviously.
Yeah. No, I think it's a really interesting example, and obviously we've seen other there is value in having the controlling shareholder where you can do those types of things. From a pure corporate finance perspective, whenever you are trading below NAV, you should buy your stock back. Whenever you are trading above NAV, you should issue stock. That doesn't happen in shipping, but like that is, if you think about how ETFs trade in terms of, again, these are exchange traded funds or the basket of stocks, those are always they're also measured on a NAV basis so that the value of the underlying stock should equal the value of the underlying fund. I have a very simple methodology. It was like, why can't shipping be the same? And instead of stocks, you have an ETF of ships. They each have sort of, assumed market values, et cetera. And so you theoretically could arbitrage them open and arbitrage such that you close any of those valuation mismatches. Say, I'll buy a ship, sell a ship, get the cash proceeds to buy shares and close those gaps. It doesn't happen, I think, in part, and this might sound more cynical than I'd like it to, is that being the management teams of public shipping companies have a very nice life and a very nice job. And for those that management teams are not controlling shareholders, most of them would like to stay in those roles, and you have a principal agent problem that is not unique to public shipping companies. I think some of those private equity funds that I mentioned that got burned in the 2010s will also point out that it happens in private shipping transactions as well. But that's, I think, a big reason why those valuation discrepancies exist, and some of them may never close.